Imagine working your entire life, saving diligently, only to discover a seemingly smart investment choice has silently cost you millions in retirement. This isn't just a fear, it's a critical mistake many investors unknowingly make with dividend ETFs, believing they're securing comfortable, reliable income. This perceived safety can be incredibly deceptive, often leading to significant long-term underperformance. For countless individuals approaching or in retirement, dividend exchange-traded funds appear the ultimate financial solution. They promise consistent income, passive cash flow, a way to live off investments without touching principal. Many assume these are unequivocally safe, reliable income generators, forming an unshakable bedrock for their golden years. This vision of financial stability is powerful, much like depositing life savings into a secure, established institution. Here lies the critical mistake jeopardizing your financial future. Many investors, driven by the desire for substantial income, chase the highest possible dividend yield, ignoring a crucial metric, total return. They opt for ETFs boasting eye-popping annual payouts, perhaps 8%, 10%, or even higher. These exceptionally high yields often originate from specialized strategies like covered call writing or concentrate investments in niche sectors with limited growth potential. While dividend checks arrive, your original principal slowly erodes or significantly underperforms the broader market. You receive impressive current income, but your actual wealth isn't growing, it's stagnating or shrinking due to inflation. This imbalance represents an insidious trap. To grasp the long-term impact, consider this analogy. Imagine owning a thriving fruit tree. You want to pick its delicious fruit, dividends, for immediate consumption. But if your entire focus is solely on maximizing the harvest now, without nurturing and ensuring the tree itself, your original investment, stays healthy and growing, eventually that tree will produce fewer fruits or even wither entirely. An ETF consistently prioritizing extremely high current yield often achieves this by sacrificing its underlying holdings' long-term health and growth potential. Over decades, this small difference in principal growth, compounded by relentless inflation, culminates in millions of dollars of lost purchasing power. Your retirement fund transforms from a growing legacy into a slowly diminishing asset base. It's like consistently withdrawing from a poorly managed bank account where principal isn't keeping pace with economic realities. The truly effective strategy for a secure retirement centers unequivocally around total return. Instead of fixating exclusively on current yield, prioritize dividend growth ETFs or diversified broad market index funds that thoughtfully include established dividend-paying companies. These superior funds are structured to prioritize a healthy balance of both current income and vital capital appreciation. While initial dividend payouts might appear comparatively smaller, their inherent design ensures dividends grow consistently and your original principal investment grows robustly alongside the broader market. This powerful combination actively works to ensure your purchasing power is not only maintained, but steadily increased throughout your retirement years, providing genuine, enduring financial security for decades. It's about empowering your money to work exponentially harder for you, rather than merely providing a modest regular stipend. Let's crystallize this with tangible numbers to illustrate the immense scale of this compounding loss. Imagine a $1 million retirement portfolio. A high-yield ETF offering a 7% annual dividend yield would provide $70,000 income per year. However, if that portfolio's underlying capital only grows at a dismal 1% annually, while the broader market consistently averages 8% per year, you're effectively missing out on a 7% compounded growth on your $1 million every single year.
Over just 2 decades, that small difference, compounded relentlessly, easily accumulates into millions of dollars that could and should have been rightfully yours. This profound divergence between enjoying a comfortable, steadily growing retirement and constantly being plagued by anxiety over inflation eroding your hard-earned savings. This single, often well-intentioned investment mistake can inflict devastating, irreversible long-term consequences on your ultimate financial freedom. Do not allow this preventable yet costly mistake to irrevocably diminish your future financial security. Dedicate some time today to meticulously analyze your current dividend ETF holdings. Critically ask yourself, are they genuinely structured to prioritize overall total return, or are you inadvertently just chasing an unsustainable, high current yield? Share your personal insights, investment strategies, or if you've already identified and corrected this common error in your own portfolio, please tell us how you adjusted your approach in the comments section below. Understanding and correctly applying the crucial distinction between total return and mere yield is absolutely fundamental for securing a truly prosperous and financially independent retirement. Your future wealth depends on it.